Hello, everyone. Happy to see everybody. Hey, we're excited about our call today. We've got Christina Kramer and Miles Gaines from Capital Group, aka a lot of you might know them as American Funds, but I think you know Capital Group as well. We also have two very smart individuals from Revisor, Nick Cargill and Ethan Dunbar, on with us. So why don't we start with some brief introductions? Christina, tell us a little bit about yourself and your role at Capital Group.
Hello, thank you so much for having me, everyone. My name is Christina Kramer. I am a relationship manager by trade with Capital Group. That means that I work as what some may call a wholesaler, I guess, in a past life, but now we've moved our way forward into calling ourselves relationship managers, partnering with RIAs across Northern Ohio, Eastern to Central Detroit, and Western Pennsylvania. I'm located neatly in Northeast Ohio, very close to the Revisor headquarters. I'm thrilled to be here and be able to speak to not only Capital Group, but some really great things that Revisor is doing in our partnership here. So thanks for having us.
Absolutely awesome. Thanks, Christina. And Miles, if you don't mind, tell us a little bit about yourself and your role at Capital Group.
Absolutely. Great to be here. Thank you all for the time. My name is Miles Gaines, Director of ETF and SMA Sales here at Capital. Think of me as an extension of Christina's team. When you are looking to create use cases or competitive analysis or, really any data to support you investing in our strategies, I'm here to help. And I also travel with Christina, very partial to Northeast Ohio. I used to cover it in my past life. So look forward to hitting the road with Christina once again and hopefully seeing some of you all. But happy to be here and hopefully we can add some value today.
Awesome. Thank you, Miles. Well, and so just to give a quick overview, the main purpose today is making the announcement that Revisor, we have added Capital Group SMAs to our platform. And so we are extremely excited about that. I know we have a lot of advisors that have used American Funds solely in their practice. It's a very beloved and popular company with financial advisors for sure. And when we got the opportunity to add Capital Group to our platform, we were ecstatic. We have a lot of advisors that were extremely excited, and we are pumped. And we're ready to talk today about markets and the strategies that can be deployed and everything in between. So why don't we start with, I've got some questions I kind of put together as I was thinking about the call today. For advisors who may be newer to Capital Group, how do you typically describe who Capital Group is and how you think about investing? So, for example, active research driven, multiple manager approaches, emphasis on stewardship, low cost, all of these different things that American Funds is known for. Why don't you give us a little breakdown, Christina, on your thoughts in that general area?
Sure. Thank you for some of those points. It sounds like you may be a little familiar with Capital Group from some of those points, Landon.
Very.
I mean, there's so much that goes into Capital Group's story. I'm thrilled to be able to even just tell you a snippet of it today. I'm going to share my screen here really quickly, if you guys don't mind. I do have a couple of documents that I think will be helpful in kind of aiding our discussion, especially as it pertains to like, who is Capital Group? What is our system? How do we invest? How are we differentiated versus our peers? But when I describe Capital Group, especially to somebody who's new, right, an advisor who's newer to us, I want to start with our purpose. Like, that is the most important thing. That's why we're here today. And our mission as a firm is to improve people's lives through successful investing. Simple as that. We have an emphasis on superior long-term outcomes from our clients. And a big part of why we're able to stay true to that is our history and the structure of Capital Group as well. So without like going into this whole history lesson for you guys, like I think it is important to touch on, we were founded almost 100 years ago, 1931. Yeah, a little before my time. I've been doing this for a while, not nearly as long as Capital, and I think a lot of us stretched on the call would be hard to say that we have. In 1934, just a couple years after Capital was launched, we launched the Investment Company of America, which was widely viewed as kind of one of those like early pillars of our equity franchise and what became this American Funds legacy, right? So you fast forward quite a few years, 1953, that's how long that marks our first investment outside of North America. So we were doing this way before like international became a cool thing to invest in, right? We continued building like this global franchise, this global research footprint, really over decades and decades. And a big part of what we've built out from an investment front is our capital system, which is this piece that I have pulled up in front of you. So the capital system is our distinctive approach to a lot of those things that you talked about, Landon, like being active, being fundamental, research-driven investors. Big part of what differentiates us when you look at the top half of this page is going to be this multi-manager system. We have each of our portfolios divided amongst multiple portfolio managers. And this is just taken like double clicking into any of our mutual funds or ETF solutions, right? There are multiple portfolio managers who invest a portion of their portfolio in really like their highest conviction ideas. A key reason why we believe this works is because no one style or thought or idea is going to win in every market environment, right? So combining these multiple managers with different approaches can provide broader diversification, deeper insights, and more importantly, reduce that key person risk that a lot of times comes into play when you're looking at active management and relying on a single star manager. One other like historical milestone for us is when we institutionalized research, is what we call it. So we give our research analysts a true seat at the table. In 1965 was when we started what we call our research portfolio concept. This is basically where our analysts don't just aren't just used for idea generation, right? They invest alongside our portfolio managers. So what that means is that their high conviction ideas are also reflected, and it makes up like a 25 to 30% sleeve in a lot of our portfolios as well. So when you see that carve out of the capital system here at the top of the page, like all of these pieces together build a really cool differentiated engine. So the capital system is really designed, like in summation, to be thoughtfully allocated, to create an opportunity for true long-term value. And then culturally, like as a firm, because I think this is important for us too, we also have an emphasis on long-term alignment, being that we have been a privately held, employee-owned company since 1931. You don't see that a lot in our industry.
No.
Being a true private company, right? The system reinforces long-term views. This is how our portfolio managers are compensated. The bulk of their compensation is tied to their 5 and 8 year return numbers, right? So they're looking long-term on your client behalf too. Our portfolio managers are heavily invested in our strategies. That's something that we've been known for over the years. 97% of our funds have at least one portfolio manager that has $1 million or more invested in those strategies. That is over double what you see in the broader industry of mutual funds. So we do so many amazing things at Capital Group. We come from a really differentiated place, and we haven't swayed over the years, although our business has evolved over the years too. And I think it's going to be fun today to share some of those ways that we've evolved as a firm.
I love it. Thank you, Christina. That was great.
Sure.
So now kind of transitioning from there to the current, let's say, product lineup state at Capital Group. I saw one of the advisors that joined us, Brad Flowers, give a shout out to Brad, awesome advisor. We're in a similar age range. And when I first got into the business, all I knew from Capital Group American Funds was just straight up mutual funds. There was nothing else on your product docket, if you will. And now we've got Capital Group, I believe, involved in significant other areas, SMAs, ETFs, et cetera. So I would love to have Miles kind of go over that with us and give us some insight into those product offerings that we see from Capital Group now compared to the good old days when there was only mutual funds on the platform.
Absolutely. It's even ironic that my role exists, an ETF and SMA specialist at Capital Group and American Funds. That's a new role that, we didn't have because we didn't offer anything else even 5 years ago. And so let's talk about what's changed in the industry. Well, clients have much higher tax implications. There's just so many more high net worth people where non-qualified money is a larger portion of their portfolios versus 10 and 20 years ago. And everybody wants more alpha, less taxes, and lower cost, right? So the industry has changed, client needs have changed, and we've had to change with it here at Capital Group and American Funds. So we launched our SMA business 7 years ago with that change in mind. And then we launched our ETF business 4 years ago. But what hasn't changed is our process, our approach, that multi-manager approach. The capital system is the same, but now you can access the capital system across different wrappers, whether it's mutual funds, ETFs, or SMAs. So it's the same ethos, the same culture, the same process that we've had for nearly 100 years. But now we're doing it in what we believe is the wrapper of the future. So we can be the partner of choice for the next 100 years. And, what I'll tell you is our ETFs, they've absolutely taken off. We're over $125 billion in just 4 years. And it's for one simple reason. You no longer have to sacrifice getting access to the capital system and then being tax inefficient. We have 25 strategies. 20 are above $1 billion. 12 are top quartile since they've incepted. And the reason why we've seen so much success is not only our process, but then also advisors. You all here on this call, we are 100% advisory sold, right? So it wouldn't happen without you. And we've seen so much inflow because people are coming back. 10 years ago, you had to choose between active management and a mutual fund and tax efficiency and beta, right? Passive ETFs. You don't have to choose anymore. And the fact of the matter is we had 25 strategies last year, same bottom-up selection, 25% on average turnover and zero capital gains, right? That's the opportunity set that we have to deliver for you and your client set on the ETF side. And, within our SMAs, we've innovated in the SMA space for a very long time. Many people don't know that we have a private client group here internally. We created it in the late 80s when a lot of our initial employees and our portfolio managers and our wealthy employees like Christina were retiring. We wanted to keep that money in-house, right? And we said, well, we need to provide access to the globe. We can do it in the mutual funds, but there were no international SMAs in existence. We created the first one, Capital Group International Equity SMA, which is now here on the platform, and we have the opportunity to provide that for your clients via your advisor. And we created that and has a very long track record, and we brought that as well as a number of different strategies to wealth in SMAs 7 years ago. So this is not the American funds of old. It's the same ethos, same culture. But now we can give your clients that same investment experience across mutual funds, ETFs, and SMAs in a tax efficient way. And really that's why we're so excited about the opportunity and really why we're so happy to be here today.
I love it. I got a real big picture macro question for you on the SMAs, ETFs, mutual fund side, because I know a lot of advisors ask about this. In general, I know there are different names and whatnot, but a lot of us that started out, using American Fund mutual funds, Growth Fund of America, Investment Company, do you have a similar strategy that we all know is the Legacy Mutual Fund on the ETF side and SMA, or is there a lot of differentiation between what's offered in those two new structures, ETFs and SMAs?
Yeah, that's a great question, and that goes back to us providing that similar experience. Our ETFs are what we call close cousins to our mutual funds. They're not clones. The fact of the matter is our mutual funds are so large, if we created clones, we wouldn't get approval in many places. So we wanted to provide something that was different enough for you all to be able to access it, but similar enough to where if you wanted a certain experience, you wouldn't have to choose between Growth Fund of America and CGGR, which is, our growth strategy. That's that close cousin. So, all of the strategies that you all know and loved, you can have a very comparable strategy on the ETF side. And for our SMAs, those are really condensed versions of our mutual funds. Those are, brothers and sisters, if you will, right? The SMAs, we want to be more concentrated, right? So we're not going to have 300 names. I would say on average about a quarter to a third of the holdings, but our SMAs are based on many of our mutual funds. So it's really, really a great opportunity to give your client access, and we'll talk more about this, but really across the book, you can be assured whether it's the mutual fund, ETF, or SMA, there's going to be a similar experience within the same asset classes.
Got it. Perfect. Perfect. That's exactly what I was looking for. Um, well, why don't we transition over to markets as a whole. I mean, everybody, I'm sure everybody on the call is curious what you all think about, 2026, what's coming down the pipe. Everybody wants to know when we have names like Capital Group. Everybody's curious to know what you all think from a markets perspective. So if you don't mind, Christina, just give us your feel 2026. What are the investment themes that Capital Group is most focused on? Dynamic growth, defending dividends. Like, what's the overall landscape or approach look like for you all right now?
Yeah, thanks, Landon. It's a very interesting year as we've started out. I can say that. Maybe not necessarily how we thought we were going to kick off the year, but that's in true markets form. So maybe I'll pivot over again. I'm going to be that girl who just shares her screen constantly.
Please. Pictures
we'll provide all of these.
Christine.
Yeah, well, we'll have all these documents if anybody would like to refer back to them as well, because there are some good things here, as well as slides that I may not get to in terms of our more comprehensive outlook, just in the sake of time today. We do have a condensed version of our outlook called the 5 keys to investing for 2026. This is one of the slides I just wanted to quickly point to as we think about our outlook for 2026 or even like the pursuit further into 2026, because really the way that we're framing our outlook is around the word balance, and maybe even more importantly around fundamentals. After a year of 2025 where policy uncertainty and tariffs disrupted earnings visibility as a big thing, 2026 at least is looking like a year where company profits are going to come back into focus. And that's a really meaningful shift for markets, right? To have a little bit more certainty around that. At the headline level, you look at global earnings growth, that's really expected to reaccelerate. Estimates are pointing to earnings growth across really all market regions, particularly strong growth around areas outside the US, like the emerging markets space, followed by the US, even some growth in Europe and in Japan. These drivers are fairly consistent too, like across these different marketplaces, right? There's declining interest rates, there's global fiscal stimulus, easing policy uncertainty, and then also you have that big elephant in the room, productivity enhancing technologies through AI, right? It all seems pretty great. We know it's not always that great, especially when you have valuations at a point like where they are today. So that really reinforces like a simple point that earnings and not headlines are going to matter most long-term for investors, right? And then from there, I think from a portfolio standpoint, we are positioned around just a couple of main themes. And you touched on it because I did share them with you, right? It's dynamic growth. And we'll talk about that. It's defending with dividends in your portfolios. And then also, I think thirdly, and probably most importantly, is diversifying with international exposure. So on the topic of dynamic growth, like this is also in the tone of being extremely selective because growth remains important, but the nature of growth is changing, right? Like those top 7 names or the Mag 7 names, top names in the S&P 500, kind of the predator is now the prey. Like this AI investment cycle is still very real, but we're moving from a phase where the returns were concentrated in just those handful of mega cap names to a phase where earning opportunities are broadening. I'm sure that's not a new idea that you've heard of broadening markets, but we're seeing it play out this year, right? In industrials and financials and infrastructure, parts of that old economy that are benefiting from AI-driven CapEx, reshoring, and global stimulus. So our emphasis on selective growth, focusing on companies where that earnings growth is durable, balance sheets are strong, valuations are defensible. Like these are the opportunities that we like in growth. Secondly, defending with dividends. If you're familiar with Capital Group strategies, you're familiar with us having always a little bit of an emphasis and a lean towards income generating securities versus our peers. And that's twofold. I mean, income is a great ballast to portfolio, and also resilience is mattering again. So I have pulled up a slide from our portfolio insights deck. We run thousands of portfolio analysis every year through our portfolio construction team. They consolidate basically the findings from those analysis that they run and put together key themes, opportunities, and advisor positioning points. Really interesting piece that I'd be happy to go through with anybody who wants to dig into the nerdy stuff about portfolio construction a little bit more. In this piece, we do highlight these themes a little bit more, right? So that increasingly relevant role of dividends to portfolios, particularly in a later cycle environment. Dividend payers and dividend growers have shown the ability to dampen volatility over time. You see that on the right-hand side of this page, right? Looking at average excess returns on the S&P 500 versus the S&P 500 in periods of market declines. Those higher dividend names are able to play a true buffer of dampening out that volatility. And we think that's going to continue to be important this year. What's particularly relevant right now, and we're starting to see a little bit of a catch-up trade here, is that dividend-oriented stocks are really attractive valuations, right? And this isn't just a value play broadly, but compared to the broader market, you see a nice discount for those quality dividend names as well. So globally, dividends are nice to contribute to portfolios. I think that's always a little bit of an added value proposition if you are looking international, which goes nice into the next theme that we have. You also can get a little bit more dividend typically out of some of those international names in your portfolio as well. And on the topic of diversifying with international, I'm going to scroll down to just one other page here quickly of this portfolio construction deck. Maybe I'll get on my high horse a little bit. There's so much that we can talk about when it comes to international investing. So maybe I won't take the wind out of some ideas that Miles want to share as well. But hey, we're at a point where profits and valuations are both checking a box, right? They're lining up. So diversifying with international in your portfolio, this is one of the most important shifts that we're seeing. After years, I don't need to tell you all, of underperformance from international and non-US markets, they're showing more of a durable comeback. We don't think that this is a head fake particularly. We see strong earnings growth expectations, as we talked about at the front end of this commentary. Valuations, yes, those are still very much reasonable relative to the US. And several of those like tailwinds are lining up too, right? So on this page, you see the weak dollar or the weakening dollar, how that's boosted international returns relative to if you were returning in local currency. You are able to take advantage of some of this really bold stimulus in Europe, right? We're seeing this pay off across areas of infrastructure and defense. And then it goes even further into areas of Asia with corporate governance reform. So from our perspective, 2026 really looks like an environment where expanding the opportunity set beyond the US is going to be increasingly important. And it's not just for diversification, but also for access to real growth opportunities. And that maybe wasn't always the story with international investing. So I'll drop the mic there because I feel like I could go on a lot more about our outlook.
No, that was great. I love it. And that kind of leads us to, so Miles, you being in your position, where do you see that outlook from Capital Group coming to life in the ETF strategies, SMA strategies, et cetera?
Absolutely. So, I'll touch on each theme and just share a few more ideas and then highlight the tickers that are, really taking advantage of those themes. So firstly, with selective growth here in the United States, we see advisors that are, in two camps that either want to stay in growth, but don't want to look and feel like the index or everybody else who has Mag 7 across, their strategy in the top 10, or looking more towards the value side to take advantage of that growth and income theme that Christina talked about. What I'll say is in CGGR, our growth ETF, that's a strategy that has outperformed the Russell 1000 growth since inception with, on average, half of the Mag 7 exposure. Right now, it's about 30%. Russell 1000 growth is anywhere from 50 to 55%. And we've outperformed it by about 60 basis points and significantly outperformed the S&P. Our forward PE is 22. Russell 1000 growth is 26. So we can look at it two ways. We can give you the same Mag 7 exposure in our growth strategy as the S&P, same forward PE, but significant outperformance. Or said another way, we can give you the same, if not a little better return in the Russell 1000 growth with significantly less risk and less concentration. And the idea is it's not a one or the other conversation, right? You can't not own the Mag 7, but it's where you're finding opportunity outside of those hyperscalers. I'll give you, a few ideas here with stocks that we're currently holding. Number one, Micron. Right? Everybody's talking about the AI build out. Well, if we're going to have these ultra fast-paced computers, you're going to need a lot of memory. Micron is the big memory provider. That's pretty obvious, right? That's a top 10 holding for us. Then you talk about the value chain or the providers to the hyperscalers. Amphenol is close to my heart, and it's also in the portfolio. It's based in Connecticut, my home state. That's about a 1% position. They're a very boring business. They make plastic connectors for wiring. But if you think about a data center build out, there's a lot of wiring that takes place to connect the computers, right? And Amphenol creates the pieces and the plastic connectors that connects wire A to wire B. That stock is up about 100% on the 1 year. And then when you talk about our strategies and how flexible we can be, we can go up to 25% international in our domestic strategies most of the time. CGGR is about 7%, but we do own SK Hynix, right? One of the top providers in semiconductors in the world. They're based in South Korea, right? So because we're active, because we have the global view, we're not only giving you access to different types of strategies here domestically, but internationally as well. And again, that's diversifying you out of what you see every single day. And we're doing that for two reasons. Number one, we want to give you more downside protection. We want to help with diversification, but also the market is broadening. Now, no one could predict a war, of course, but when you look at last year, only two of the seven Mag 7 strategies were in the top 100 performers in the S&P. Only two. That's NVIDIA and Alphabet. Over 60% of the S&P 500 was moving above its 200-day moving average coming into this year. It's about 50% now, but it's still more than half of the top index in the world, right? And obviously, I don't need to tell you all seven of the Mag 7 stocks are down this year. So diversification helps, and that's why you'll see that we're protecting a lot on the downside. So that's if you want to stay in growth, and if you really want to look to the value opportunity here, CGDV is our largest asset gatherer, to top 10 asset gatherer in active flows this year. It's the Ferrari, it's the Apple iPhone, it's the Jordan 1. It's in the first percentile since inception, and it's number one, not just first percentile, over 4 years in the value category. Now it toes the line of value or blend, but when you think about a multi-manager approach with a growth and income mandate, you're tying our deep value manager with our contrarian growth manager. So we own energy companies like Halliburton, but pairing that with buying strategies like stocks like NVIDIA. We bought it when it was trading 15 times earnings last year in April, right? That's a relative value opportunity. It's not a deep value strategy. It's relative value. We have a 90% investment grade debt mandate. So we're not just saying we're buying deep value traps. We're saying if you're a value company, show us. And if you have investment grade debt, we believe that you will be. So it's really high quality because we're looking across the books, both on the equity and the fixed income side. And we still have a yield bogey above the S&P on average since inception. It's been about 44% yield above the S&P. So we're giving you that upside, we're giving you that enhanced income, and we're being selective with how we're allocating. And CGDV and CGGR are two major portions of our models, right? Two very large allocations across the spectrum in the models that we've built that you now all have access to on this call. So that's selective growth. And talking about dividends. And as we look internationally and globally, talking about international and dividends, I would say Christina hit the nail on the head, right? We don't think this is a flash in the pan on international. When you think of stimulus in Europe, right? More pro-growth stances in Japan and China, right? A very different rate environment. and really the rest of the world trying to keep up with domestic returns, we think that there is a long-term trend in international, and then a falling dollar is the cherry on top, right? So when you think about all those things, and specifically a falling dollar, 2003 to 2011, right, was really a long-term trend of the dollar falling. We saw that the MSCI EAFE dividend index outperformed the traditional MSCI EAFE index by about 35%, right? International performance with a falling dollar. We think that we're in that environment now. And we have two strategies, one global and one international, that have a dividend focus, that are in that blend area, that can really play both sides of value and growth. So for those advisors who really want a global exposure via the SMA or looking at the ETF, CGDG Dividend Growers, it's got 10% less tech than the All Country World Index. It's got a 3% yield, and it's 50-50 US to international. Or you're looking at the just international strategy, CGIC International Core. That's got about a 3% yield as well, and it's 100% international, but in that blend space as well. And then, I think that really helps you get access to international. And the last piece I'll say is international is very cyclical. So, from 2016 to 2020, international growth outperformed international value by about 40%. From 2021 to year to date, international value is outperforming international growth by about 70%, right? So international is very, very, very cyclical. And we think the next leg of international returns is a broadening story, going back towards growth like we saw from 16 to 2020. And that means we're very well positioned in our international equity SMA that I mentioned earlier. It's a double mandate of growth and prudent protection on the downside, but it's in that growth to blend category. And the last time that we saw growth outperforming value, we had significant outperformance with a lot of downside protection as well. So, whether it's ETFs that you're leveraging via the models or the SMAs that we have to offer. And I'll also say, I mentioned CGDV, that dividend value, US income and growth is its comparable SMA. I mentioned our dividend growth global strategy, World Dividend Growers is the comparable SMA. And then, of course, I mentioned international equity as well. So whether you're looking to take advantage of these themes for where our portfolio managers are adding to within the models, and you can see that we've added to these areas, or you want to select the SMA to take advantage of these themes, either way, I'm very confident with our product offering and you all being able to take advantage of these themes.
I love it, Miles. That was awesome. That gives me there was a bunch of numbers you threw out there that were surprising to me, and that was very enlightening, actually. Let's transition a bit, and what I'd like to cover, we've got the advisors that we work with. It's a spectrum of belief. We've got folks that are totally accustomed, and it feels let's just call it right to them philosophically, to have every part of the asset allocation in active management, actively managed bonds, actively managed small cap, large cap, value growth, all the above. We have advisors that are trying to keep costs down as much as humanly possible internally, whether it's ETFs, mutual funds, SMAs, whatever the case may be. And they're looking for single digit expense ratios, essentially cap weighted, index mimicking portfolios. And then we have some folks in the middle as well. So a lot of folks, think like factor tilting, DFA type of approach, where you've got some potential for alpha. Maybe you're paying 20, 25 basis points for some alpha potential without, the full on active management mindset. And so we've got, those different philosophies across the board. Let's kind of unpack, I know big picture, one of the reasons that myself and a lot of folks loved American Funds when there was just a mutual fund lineup was we had this active and this alpha potentiality, but with a very competitive expense ratio. So you guys have always been known in my, at least in my opinion and in most advisors' opinion, to have great results, net results, and very, very competitive expense ratios for active management. So tell us your thoughts, Miles, on just really big picture. What do you think? What's your philosophy? What's American Fund's philosophy? What do you think makes sense from a active versus passive scenario? If you had to pick certain, let's say, certain parts of the asset allocation where you had to go active, what would that look like in your mind? Just give us your overall thought on that active versus passive mindset and where active might make the most sense in a portfolio.
Yeah, absolutely. It goes back to what we discussed earlier. For the longest time, advisors, had to choose between active management and tax efficiency and or low cost, as you mentioned. Now, American funds, most of our strategies are in the, top or bottom quartile, depending how you look at it, or the best quartile in for cost. But, if you're owning us in non-qual, you still, might get a hefty cap gain at the end of the year. And advisors, with changing client demands, had to go to beta. It's as simple as that. And the fact of the matter is, really, since 2009, that trade has worked. That was the right call in many cases, right? When rates are at zero, when there's less geopolitical risk, and there's just these large companies, Mag 7, if you will, it was different names at different times, leading the market. Why not own cheap beta, right? So we've seen advisors use passive for that tax efficiency, that low cost, and quite frankly for outperformance. It's interesting that there is a number over 500 strategies benchmarked to the S&P 500, and you all can look this up on the S&P website. Only 11% outperform the S&P over 15 plus years. Now, the reason why I choose to wear the Capital Group jersey and why Christina chooses to wear the Capital Group jersey is because we have 5 mutual funds dating back to 1976 when the first S&P index fund was created. 4 outperform significantly, and 1 gives you essentially the same return with half the risk. And since we've launched the S&P, our ETFs, all 3 of our strategies benchmark to the S&P give you outperformance, and now you're not getting any gains, right? So I don't even know if this is an active pitch. This is a Capital Group and American Funds pitch, right? But if you have a cost threshold, beta makes sense. If you just want, quick exposure, if you're looking to make a trade to deploy money while your client is making a decision to go elsewhere, that absolutely makes sense. If you have an investment policy statement, right, you want to have low tracking error, that's also why you would use beta, right? If you don't want to have crazy standard deviation, or if you're not a quote unquote trader, then beta makes sense. But people are continually adding us with passive because of what we're talking about right now. Markets broadening, right? Changing world politics, right? And who knows if the top 10 in the S&P look the same over the next decade, or the all country world index over the next decade like they did the last decade. And the hint there is it's never looked the same 2 decades in a row, right? So in changing market dynamics and changing geopolitical environments, it makes sense to be active. And now that you can do that with low cost, it makes sense to pair us up. Get your beta, right? Keep some of your costs down. But there's absolutely areas where, number one, we can be additive and have been additive and continue to be additive. But also where it makes sense to protect your portfolios. So we've seen a lot of people use beta in large cap in particular. As I mentioned, CGDV and CGGR, they're abnormal, but those are absolutely complements. You'll see a lot of times people will use small cap for active, and then absolutely, international. But I'd say where you probably see beta the most is large cap, right? Maybe your ag exposure, but those satellites be active. And what I'll say is changing dynamics in large cap. Obviously, small cap is not what it used to be. Think private equity, think companies just being unprofitable. Even in bonds, right? Over 50% of funds benchmarked to the ag beat in over 3 years. So there's money to be made in bonds. So everybody's different. Every portfolio is different. It depends on the client. It depends on how you operate. It depends on the policy statement. But there's absolutely worlds where they can live together. And the last thing I'll say, and this is again is particular to Capital Group, The reason why people own us so much is because you also want to get opportunities that are outside the benchmark, right? So the best example I'll give you is Tesla. Everybody knows that the S&P 500 represents the largest 500 companies here in the US. Well, that's with a caveat. You get added to the S&P after you have 4 quarters of consecutive earnings, and then there's board approval, actual humans voting on whether or not you get added. By the way, that's an active decision, right? So everyone, again, thinks they own the largest 500 companies. Well, Tesla IPO'd in 2010. It wasn't added to the S&P until 2020 when it was the 6th largest stock in the United States. Why is that? Because they were running on net operating losses, right? And then they got board approval. So Tesla's up almost 25,000% since it IPO'd. Since it's added to the S&P, it's up about 80. Well, the S&P is up almost 100. So it's actually been a drag if you've only owned it via beta. Meanwhile, we've owned Tesla since it was a small cap in small cap world, and it's graduated up to some of our large cap strategies, and we still own it. Has been a drag recently, sure, but we've experienced much more of that 25,000% versus that 80% in beta. So, beta makes sense. It depends on the client. It depends on the portfolio. It depends on how you operate your business. But it makes a lot of sense, specifically in this environment, to go active and to choose capital.
I love it. And I love what you said there. A lot of now for some of the advisors on the call, they already believe in active management. The folks that don't, they normally take the research where we've taken every active manager on the earth and we have all of the little problems that exist, so Scarpetti, I believe, is it Joe Scarpetti? I don't know if he's still with American Funds or not, but
Yes,
when
he is.
I've heard him speak a couple of times, and he does this thing where he talks about not everybody can dunk. He does this example with basketball. He's like, hey, some basketball players can dunk, some basketball players can't dunk,
That's right.
And he uses that analogy with American Funds. And I think that's a really important piece, because not only when we talk about expenses, it's like, if we're doing active management and we get our expenses down a little bit compared to the average, that just makes it easier to outperform, to do well. If your expense ratio was 4% as opposed to 40 basis points, that's a big difference. It's a big nut to crack. So I'm glad you pointed that out, because it's just so impressive to look at Capital Group's results compared to benchmarks. Not if you look at the entire active world and you put everything together, but when you just focus in on American Funds Capital Group, it looks phenomenal. So thank you, Miles, for clarifying that. Yes, very, very important. So let's transition, Christina. Let's talk a little bit about implementation of strategies on the Revisor platform. Operational efficiencies, what this looks like in practice. We have advisors that have not had great operational platforms in the past, and they've had to do things like open up one account for each SMA, and they've had these issues like that. We get that question a lot. So if you don't mind, give us a little breakdown of how that works and what that looks like when your strategies are offered on a platform like Revisor.
Yeah, I mean, this is something I'm really passionate about, especially as I'm meeting with firms and fortunate enough to be able to be a partner to them and have true business operational conversations, like not just investment focused, but how are you operating at a high level in order to help scale your growth, right? So what I've been seeing across the RIA landscape is 100% technology adoption is table stakes, like across their business in general. But to be frank, particularly around investment management. Really the only way that you could easily manage model portfolios and scale them across your book of business, which is what everyone's doing, by the way, like everybody's moving towards models, is through a technology component, right? As a build out. In addition, a lot of times to your custodian already. Like here at CG, we're great and everything, but there's really not a way to access our models turnkey direct to Capital Group. You can't do it. Same with SMAs. You could do it through your custodian a lot of times, but then there's other operational disruptions and added costs depending on the platform. So, when I look at the numbers, like it's not surprising to me that RIAs are now the largest segment user of TAMPs. 46% of TAMP users are RIAs. So that's making them the single biggest when you look at them ahead of the wirehouses and independent broker dealers and banks and et cetera. And it's because and you have this conversation with clients in order to like really like pound the table on the opportunity with you guys at Revisor with the competitive cost that you have at play as well. But this is a huge cut for them on time spent, right? On average, 11% of time is spent on investment management when you use a TAMP versus 25+% if you're managing your portfolios in-house. So I think it's one of the most important conversations that I can be having with my firms that I work with and that'll lend an ear to me because the advisor reality that you're hearing every day is that outsourcing investment management is helping them free up time for growth, for planning, and for like those ultra high net worth complex opportunities that they're trying to move up market and get more planning strategy at hand. I don't think that what we do at Capital Group is commoditized across the broader industry, but investment management kind of is commoditized across the broader industry, right? So what like you want to be spending time as an advisor in your seat, is it truly not only managing underlying investments, but also like scaling those out operationally? So I think platforms like Revisor in reindustrializing or industrializing what could be like a very manual process is really important because RIAs that are doing this, it's lowering your operating costs. It's giving you higher AUM growth across your book relative to peers who are not using as many digital supplementations or applications. And the solutions come at a very cost competitive way as well. So this is just like a sidebar utilizing Capital Group SMAs through Revisor. Not only are you able to get in at a lower price point from the management fee or the expense standpoint because you're going in with a partner like Revisor, but you're getting lower entry points as well. If you were to just have a master dual contract with us at Capital Group, there are pretty substantial minimums for that. Unfortunately, it's just like the economics of it, right? But through a TAMP provider, we can really bring that down. Don't have to meet as high minimums. You can get better pricing, and then you get all of this operational efficiency with it. I just think it's a no-brainer.
We can throw your sleeves, your SMA sleeves into any account. So they, a lot of these advisors are accustomed to having to pick, one strategy for the account. And this just, kind of opens up the open architecture structure and makes it very, very easy for them to implement your strategies, which is great. And kind of leads me to my last question for y'all, which is, what's the best way for advisors to get more information and to get started, get conversations with your team, or just what's the next steps for advisors that are interested in learning more or possibly moving forward?
Thanks, Landon. Yeah, I'm thrilled to like continue this conversation because this is just an intro. Hopefully you all have gotten to learn a little bit more about Capital Group, about how we're partnering with a Revisor, and really excited about this opportunity. We're here to help. We're here to strategize and provide insights. So we're running what we're calling office hours. It's very informal. So please don't think it's like college level office hours where you have to go in and speak to it's not like that. It's just come one, come all. We're going to do one next Friday, March 27th from 12 to 1 p.m. So just during your lunch hour, if you have any questions and just want to pop in, please do let us know, anybody on the Revisor team, or you can reach out to myself or Miles and we can forward a calendar hold along. The platform is live now. Documents are accessible if you want to do your own research on these strategies in the interim and learn more on your own. My email is my name, Christina.Kramer@capgroup.com. I'm not going to drop my phone number here for you guys because like emails is what everybody's doing anyways. But you reach out to anybody on the Revisor team, they'll make sure that you get pointed in the right direction for anything specific that we can help with on the Capital Group front.
Yeah, and Advisor, just like everything else, all other strategies or any other questions you've had, we're talking with you all almost every day. So same story. You can reach out to the Ethan, the Nick, the Garretts, the Ians, the whomever, and we'll be able to spend as much time as is needed to see how this can fit into your overall model portfolio strategy and any other questions you might have. I was wondering as well, Ethan and Nick, you've been sitting here looking pretty and looking smart over there. Did anything pop up in your minds? Any questions or any additional thoughts that were going on in your minds as we've been talking here for the last 45 minutes?
No, I think you guys covered it perfectly. I'm really excited to have Capital Group on the platform. I think it really complements what we have going already. It's going to fit into a lot of advisor strategies and a lot of client strategies really, really nicely. So just excited to be partnered with you all, and that's really it from me.
Perfect. Awesome. Thank you. Nick, were you going to say something, brother?
Nope, I was just going to agree with Ethan. I think this has been a great introduction to the platform. Excited to have more conversations with everyone about it.
Awesome. Thank you. Thank you. Well, I don't know if we have time today. I don't know if I haven't seen any questions pop through, but happy to take a few. I think, is everybody good until 3 o'clock? We have a few additional minutes here. Nick, have you or Eva, have you seen any questions come through from the advisors that are logged in?
I have not seen any come in yet.
Okay.
Certainly open up the floor. We'll see if anyone's got anything.
All right.
Don't be shy.
Yeah.
Got anything? We're all friends here.
Ask away. Absolutely. No, all good. Sometimes we have a shy bunch, so no worries. Just wanted to make sure gave everyone the opportunity. Awesome. Well, if we don't have any questions from the audience, then Miles, Christina, if anybody else has any closing words, feel free. If not, we can conclude.
No, just that everybody can't dunk, and I'm willing to bet, Landon, you've dunked once or twice in your.
That's right. Absolutely. Absolutely. I love it. Well, American Funds can definitely dunk, and we look forward to seeing y'all and seeing what you can do. We're so excited and appreciate you very much.
Absolutely. Thank you for having us.
Likewise.
Absolutely. All
Thank
right.
you,
Thanks,
Landon,
everyone.
Ethan,
Bye-bye.
Nick, Eva. Bye, everyone.
Everybody, thank you.